So without further delay, I will pass it off to Nick and let him take over.
Thank you, Peter. Yeah, this stuff is pretty exciting to me. So this talk is Introduction to Decentralized Finance. I decided covering all of blockchain technology is a bit ambitious, so I wanted to focus on that which might be interesting to finance students, but also more generally to people that like to make money. A bit about myself. I'm lead blockchain engineer for Consensus Software Incorporated. Consensus Software is a software shop that builds blockchain technology solutions. Most specifically, I work on software development tools, specifically the Truffle software development tool. But that's not what my talk is about. I've been involved in the ecosystem here for about 5 years, since 2016. I'm really into this stuff, and I hope to share that passion with you. As it says, this is not financial advice. I can't make any guarantees. I have a lot of my, assets in these systems. I use them almost every day. I try and keep informed, but there are always risks, as with anything. So, oh yeah, and just to reiterate, please ask questions. I have about 30 slides. They're fairly sparse, and they build on each other. So if anything doesn't make sense, my goal really is for everyone here to understand the material that I present. So please ask questions. I'm monitoring the Zoom chat. I'll put the slides link in again for people that may have joined late. Feel free to follow along, ask questions, and hope you learned something. So decentralized finance, I have this screenshot here. In the description, I linked to this site in January, and it was $24 billion in DeFi, and now that's more than doubled. So I know that's kind of a drop in the bucket compared to the $70 trillion financial industry. But I mean, just looking at the chart here, it's grown leaps and bounds, right? So I think DeFi is here to stay. And today I'll talk to you about some of the building blocks that make up decentralized finance. So what does that look like? Well, I'll start by just talking about a few key concepts. I'll try not to go into too much detail about the technology because I don't think it's necessarily relevant. Then as I conduct this talk, I'm going to be interacting with the services that I describe so you can kind of see how it works. So I'll talk about what software you would need to install to do this, to participate in this ecosystem yourself. Then I'll go through, I sometimes watch Reddit, Aaron. Then I'll go through a number of case studies. This is by no means comprehensive. There's so many applications and financial systems that are a part of DeFi now. I mean, if you look at that DeFi Pulse website, you can, the list just goes on, right? So I picked 5 that I think kind of show what DeFi is and what power it provides to users and, people that want to invest or participate in kind of these financial instruments. So I'll go through those 5 and then summarize, and maybe we'll have some discussion about all of this and how it all fits together. So without further ado, the first key concept is really, what is a smart contract? So the definition I came up with for what a smart contract is, it's terms and conditions as a public good, right? You might enter into a contract with someone, you might enter into a contract with, say, Vanguard to hold your money, invest your money. You enter into a contract with a bank. All of these use a central authority. You have to trust someone with your funds. Smart contracts, it's terms and conditions without that trust. So these terms and conditions, they're maintained by a network of computers. This network of computers, this network of computers all runs these smart contracts. They execute these smart contracts. So if I have, let's say I want to invest some money into some financial instrument, there will be a smart contract that I would interact with. I would say, hey, smart contract, please hold on to my funds, give me the return on investment that you offer. And this entire network of computers will execute this smart contract day in, day out, theoretically until the end of time. And this all works because the computers that run this network are incentivized to do so. So anything that you do in DeFi, you have to pay transaction fees. And these transaction fees are what makes sure the system keeps running. Hopefully that's enough of an introduction that you can kind of trust me when, I mean, there are going to be some percentage yields like APY on screen and you might not believe it. That's in part because this is a very new space. There's not a lot of people participating in this yet, so the interest rates haven't been driven down, but also because there's no central authority that's taking their cut, or the central authorities that do take a cut is very minor. So those are the basics. I mean, there are probably more terms. If the term comes up that you don't understand, just put it in the chat. I'll try and give a working definition. So how to get started? Well, there's this MetaMask browser extension that I have installed. This is a test account. Don't look at me like I'm this rich. But if you install this extension, it runs in your web browser and it lets you interact with decentralized finance systems. So you can install that. I put a link in the slide here. I also, I've received a lot of recommendations for this book. I picked up a copy of this book in preparation for giving this talk. It covers kind of step-by-step for a lay audience on getting started with this stuff. But as always, I encourage everyone to do their own research. Like, these systems are complex. They are indistinguishable from magic, quite frankly. So, you know, make sure you're comfortable before you throw money into something that could disappear or could break catastrophically. I won't go through the actual process of setting up MetaMask. It's a browser extension. If you go to the website, you can install it pretty easily. You can buy Ether with MetaMask. There's probably a surcharge. I'm not sure what that is, but you need to actually fund your MetaMask account with Ether in order to do these things. Ether is a cryptocurrency similar to Bitcoin, for those not familiar. All of decentralized finance, or almost all of decentralized finance, happens on the Ethereum blockchain. So Ether is kind of the native currency there. So any questions before I move on? So Ether is not the only currency used. It's kind of like each project has its own currency, and I'll get into this. Ether is what transaction fees are paid as, right? So if I want to send some Ether, maybe I'll send some Ether to myself. Oh, this one doesn't work. Like if I just copy my own address and I try and send Ether to myself, and maybe I send 1 Ether, I have to pay a transaction fee. And you'll see that transaction fee is paid in Ether. And it's the same if I want to send myself or send anyone DAI, another currency. So on the Ethereum network, there can be countless different currencies. But if I want to send 100 DAI, I still have to pay Ether. Does that make sense, Evan? Cool. And throughout this talk, like basically all of these projects that I'm going to be showing you, all these case studies, they will have their own token that you can buy or sell on the open market. So I'll start with Compound. Compound is a decentralized lending and borrowing platform, and it looks like this. I also have a tab open. We'll interact with it. Compound allows anyone. Transaction fees are annoyingly expensive, Con. So if I gave this talk in January, I would have recommended that anyone can get started with very little money. Now I would say that it can be prohibitively expensive unless you are willing to invest thousands of dollars. The cost of transaction fees does not go up with the amount of funds. So you could, it's the same transaction fee. Like if you're doing a particular operation that's $100, it's the same transaction fee as if you were doing $5,000. The fee is measured based on the complexity of the transaction. So in going through these things, if I'm going to interact with Compound, that will be different than interacting with Uniswap, say, because different smart contracts have different complexity, and the network has to get paid, and the network wants to get paid more for doing things that are more complex, right? It costs them more electricity, so they want to get paid more. And I can go into details a little bit later if you're still curious about how that works, but you'll see as I click through things. So Compound is decentralized lending and borrowing. Anyone can deposit some assets, and they support a number of assets, DAI, Ether, all of the things listed. And if you have these assets, you can deposit them and earn some APY from people borrowing, right? People will borrow your assets and you'll collect a return on investment. You can withdraw this at any time. It's all protected by the smart contract. So that's kind of the lending side. I'll go through lending and borrowing first, and then I'll walk you through it, actually doing the mechanisms here to make this work. So on the borrowing side, you first have to lock up funds as collateral. And that's because there's no identity here, right? Like if you look at my MetaMask that dropped down, this is just my address. This is not associated with my government ID. This isn't associated with anything. I could generate a new address right now, and like it's not tied to anything apart from this like string of letters and numbers. So if I want to borrow money, I have to put up collateral. And you'll see that on all of these systems is if you want to get something, you have to put up some collateral. And that protects the lenders, right? Because if I'm going to be lending in this screenshot, I'm lending $5,000. I don't want that to disappear. I can trust that it won't disappear because everyone that's borrowing from me is putting up their own collateral. So if there's ever a default, I'll get paid back by their collateral, the borrower's collateral. Does that following along so far? It might help if I actually show how this works. So I have, this is a test net. I'm gonna just be using a test net for almost all of these demos. So I have 9,000 DAI, or I'll do Ether to start. I have in my test network account, I have 400 something Ether. I'm going to lend 100 Ether. And this just works like a website. You need to have MetaMask installed. I'll put the slides link in the Zoom chat again, because I've heard some people join late. So if you anyone who joined late, you click on the slides. There's instructions for installing this MetaMask software. So I'm going to use MetaMask to supply 100 Ether. And you'll notice there's the 100 Ether I'm sending. This 100 Ether will be locked up and earn, it looks like 12% interest yearly, and I have to pay the transaction fee. So I'll just do that. This will get sent to the network. And now at this point, the network is verifying that I did everything correctly, right? The smart contract ran. And here we go. You can see I'm now supplying the lending pool with $40,000 worth of Ether, fake Ether. This is still a test net. MetaMask is wallet software that lets you interact with decentralized finance from a browser. So it holds your funds and it lets you use your funds to interact with these systems. Does that make sense, David? It's a bit like Coinbase. Coinbase handles the wallet side of things, but the difference, I guess, would be that MetaMask is self-sovereign is the term. You control the keys yourself. So when you go to create a Coinbase account, you give them your government ID. If you lose your password, you have to ask Coinbase support. They can recover your password. MetaMask, you have to manage all of this yourself, so there's additional risk. You have to make sure that you keep your recovery keys safe. But also one thing that Coinbase does not do is live in your web browser so that you can interact with these services, right? Like, as far as I'm aware, there's nothing inside Coinbase that lets you go, hey, I want to deposit 100 Ether into Compound. In order to do that, you need software like MetaMask. And there's a couple alternatives. MetaMask is the most widely used and probably the most user-friendly tool for doing this. In order to transfer, if you have in if you have crypto in Coinbase and you want to transfer it to MetaMask, you copy your address to your clipboard and go into Coinbase and use the Coinbase UI to send to that address, like do, copy to clipboard, and then over in Coinbase, do Control V or what have you to transfer here. Because you need your Ether or whatever other crypto, you need that in the MetaMask account itself. It won't do you any good. If you're trying to use DeFi, keeping your assets in Coinbase won't work. You need your assets in this account, right? I'm not familiar with Uphold, but I imagine it works about the same. The idea with crypto is you get this address, right? So I think I can, it's like here, this is this testnet address of mine. Anything that manages an account like this, you should be able to transfer freely between. So you could transfer from Coinbase to MetaMask. You can transfer, I don't know what Uphold is. I'm assuming it's similar. You can transfer from MetaMask back to Coinbase. The idea here is it's all very interoperable. How much have I made so far? It's similar to Coinbase. Yeah, it's probably about the same. So Coinbase is like an on-ramp. Coinbase does all of the regulatory business so that they will, so that the government will sanction them taking money from you and giving you this magic funny money. MetaMask doesn't do that. MetaMask will manage your magic funny money, but it's not an on-ramp and it's not an off-ramp. So I haven't earned anything yet. I mean, I'm only getting 12% interest, so I was hoping this number would go up a little bit, but it hasn't. Now let's do the borrowing side. So in order to do the borrowing side, I have to enable. So right now, what I did was I deposited 100 Ether into Compound. I'm earning 12.51% yearly interest. This amount fluctuates. But if I want to borrow money, I have to say, all right, you can use my 100 Ether as collateral. And you can't see this. Oh, shoot. You can't see this other window that pops up. Give me one sec. Hopefully, I just realized I was sharing. All right. Can you see both of these windows now?
Yes.
Cool. Yeah. Sorry, that was probably confusing. I was assuming that you could see everything, but yeah. So every time you do anything, you'll get a little pop-up that says, "Are you sure you want to do this?" And then you hit confirm. So I'm enabling my 100 Ether as collateral. This means that if I borrow too much or the price of Ether drops and my borrowed asset exceeds the value, like the safe value of my collateral, then my collateral will be taken from me. So I'll just show you now that I've done this as collateral. I can borrow. I'll borrow $5,000 worth of DAI stablecoin, and I can actually borrow up to. I can borrow up to $24,000 because I can borrow up to 80% of my collateral, but I'll only borrow 5,000 DAI. And you probably can't see it now, but if I do this, you can see another pop-up appeared. And this is asking me to confirm, hey, are you sure you want to do this? I say yes. And now it's propagating across the network. And pretty soon I should see my borrow balance go up. Yeah, I did say that MetaMask holds your funds. MetaMask actually just holds your credentials. So there's, I'm not going to reveal it, but under the hood here, there's like a 12-word seed phrase. I can show you an example. I happen to have, oops, sorry. I happen to have this document here. You can see like, you could have a 12-word seed phrase, and now it's like a recovery key. So I have a similar 12 words that are powering MetaMask right now. That is me. And I could take those 12 words to another computer, to another MetaMask installation, and have the same identity. Does that answer your question, Amal? Anissa, as far as your question, the deposited money that I put in does not have to be collateral. If I want to use Compound, I don't have to borrow anything. I can just put up 100 Ether to lend to others, and others will borrow, and I'll get whatever the interest rate is at the time. If I want to additionally borrow funds, then I have to lock it up as collateral. I have to flip this check mark, which basically authorizes the system to say, if you borrow too much, then we're going to take your collateral from you, similar to a house loan or something. Did this go through? It did not. Try this again. Yeah, it's high interest. 12 interest is a high interest rate for a bank, but 12% interest is a low interest rate for DeFi, which is why you might not believe this stuff, but it's a new field. So I imagine that if I make a compelling argument that this stuff is worthwhile, and you all go invest some money, well, this 12.5% might then drop to 12.3%. And if you tell all your friends, then the interest rate will drop a little bit more. This stuff is all controlled by financial math that I don't understand, right? Like if more people are borrowing something, then the borrow interest rate is going to go up, is supply and demand. Similarly, if more people are supplying Ether, the interest rate will drop. So these things are constantly fluctuating. Well, the reason for doing it, Beth, is I don't know if you like the 0.5% that your bank tells you is a good interest rate. I don't. I'm not satisfied with that. I would much rather have double-digit interest rate. At times, you're able to catch triple-digit interest rate. I mean, there's increased risk, but I mean, I think this is where the future is at. So I don't know why this isn't working, showing me the amount I borrowed. Something's going on. I think it's the next internet boom. I will address the risk. So all of these things, I'll address them right now. All of this is controlled by computer code. When I put money in here, there is some computer code that says only I can withdraw it. If I want my 100 Ether back, I can get my 100 Ether back, but you should not be able to get my 100 Ether. I don't know if you've ever used computers before, but they break all the time. So if there's always going to be this risk that some bug is discovered later that can be catastrophic, right? Like I could lose 100 Ether to some kind of bug here. So there's definitely risk, and this happens all the time. There are new projects in the DeFi space that, you know, it could be like a period of a week where there will be some new project. It'll seem very, very promising. Millions of dollars, hundreds of millions of dollars might be put into this new system. And then within 2 days, a bug is discovered and all $100 million is lost. This happens. So there is certainly risk. I wouldn't recommend joining a project that is not well regarded. Like, do your own research. Like the ones that I'm talking about here in my talk today, Compound is well regarded. It's been through many formal audits, and the system has been operating for years. Well, a year and a half probably for Compound. So there's some amount of trust that you may have in this system, but don't invest more than you can afford to lose. So anyway, that's Compound. Is decentralized borrowing and lending. That's kind of like the first building block, right? what is the financial system based on? Well, borrowing and lending is a key component of any financial system. Properties I look at when I'm evaluating one of these protocols is I look for other people I trust who have vetted it. I'm not qualified to audit a particular smart contract. I can reason about a smart contract somewhat, but it very much depends on like the people that made this smart contract. Do they know what they're doing? Are they working with others that know what they're doing, right? And if it seems particularly risky, or before I put in thousands upon thousands of dollars, I will wait to see. And I'll make sure that it doesn't explode and have some catastrophic failure. Yeah, you can lose. There's risk with stocks as well. I don't think there's no risk of a software bug with stocks because it's protected by regulation. DeFi is not currently protected by regulation in the same way. And arguably, it's impossible to protect with regulation, right? You saw me just interact. I just moved, well, fake money around. But if it were real money, you just watched me move 100 Ether is like, what, $20,000, $200,000? I just moved that around without anyone getting in the way. So it's a little bit, there is increased risk versus stocks, but that's, risk reward. That's why the interest rates are higher. So anyway, that's compound. The next building block that I think is important to discuss is DAI, and you've already seen this inside the compound UI. DAI is a stable coin that doesn't have a central authority, meaning like if you're familiar with crypto, you may have seen Tether or USDC. There are these assets that are valued at $1. And the value of that, right? Like, I mean, you've heard Bitcoin and how volatile Bitcoin is not very useful if you want to do finance, if you can't trust the value of your assets. So DAI is it's a stable coin. Each DAI is worth $1, and it's powered by a decentralized, like an over-collateralized loan system. So, Con, you're anticipating my points. What kind of collateral is acceptable? Well, I can show you. This is on the test net right now. Ether is, well, if I switch to mainnet. So this is a long way of saying that show all collateral types. There are a ton of collateral types. So you can borrow DAI. Remember, DAI is worth $1 given any of these various assets, right? So Ether is the main one. There's all these other tokens. If you hold these tokens, you can lock up these tokens and get DAI. And so on my test net, I'll go back there because that's what I've prepared. On my test net, I locked up 100 fake Ether and I withdrew, what is that, 10,000 fake DAI. And that's what powers all of this. What powers DAI is this system. The system is organized, like developed and maintained by a group, MakerDAO. And they've built these smart contracts that allow anyone permissionlessly to lock up these assets, that whole list of collateral types that I just showed you. And using that collateral, you can say, hey, give me some DAI. And then MakerDAO the smart contract will generate the DAI automatically on your request up to some threshold, right? So on Maker, it's like 150%. Your collateral must be 150% the value of your borrowed DAI. And so if you see here, I can generate up to, based on my 100 Ether, I can generate up to 29,000 more DAI. And this DAI is created out of thin air. So the supply increases when this happens. And I might go and I don't know what I want to do with this DAI with $29,000. Maybe I'll buy a decent car. There's the risk, though, that there's too much DAI on the market. What keeps DAI worth $1? It's not some central authority that says DAI will always be worth $1. No, the smart contract observes the price of DAI on the market constantly. There are systems that are constantly watching the price of DAI, and if the price of DAI goes down, if the price of DAI is below $1, well, that means there's too much DAI on the market. So we need to decrease the supply or increase the demand. If the price of DAI goes above $1, that means there's not enough DAI. More people want DAI because they're willing to pay a premium for it. So the smart contracts, they observe these price fluctuations and they make adjustments to the system to compensate. And what does that look like? Well, if the supply needs to increase, all of the DAI, there's 3 billion DAI that exist today, generated out of thin air based on people's collateral. If there's not enough supply, right, if the price of DAI is above $1, then that means there needs to be more DAI. So the system will lower the interest rate to encourage people to borrow it. Similarly, if the price of DAI drops and is too low, that means that there is more DAI than is allowable, right? I mean, the whole point is that DAI is $1. So if DAI is trading at 95 cents, that means that demand needs to increase. And how can you make demand increase? Well, you can raise the interest rate of all of these loans. And raising the interest rate on a loan is a good way to encourage people to pay off their loans. And so they have to come up with DAI. They maybe have to purchase DAI on the open market, right? So they buy that 95-cent DAI on the open market. They raise the price back to $1 so that they can pay off the loan. There's a number of other systems in place with DAI and MakerDAO. I mean, a big one is the fact that DAI has been stable at around $1. If you look at my first chart, it's roughly been $1 since January of 2018. So that is this like social trust, right? Because if I see DAI trading at $1.05 and I'm holding DAI, I might think, well, I could sell this for $1.05 while I can, because it's going to go down to $1. So Khan, these currencies cannot, they can be created by other means. So I just walked you through DAI, which is created via this system of lending. Ultimately, Ether is created via mining. That's the process that you're thinking of. But one thing that a smart contract can do is define a new asset. And so this smart contract exists that defines what DAI is. And what DAI is the stablecoin. And the smart contract says these are the conditions that need to exist in order to create new DAI. This is what happens to DAI when it's destroyed. And so it's a lot more flexible than just like farming or mining, right? Does that make sense? I guess the idea is there's this native currency of Ether that's created at the very lowest level. That's the network that operates the network that ferries your transactions and processes your transactions. But on top of that is this generalized system of just like terms and conditions, like, hey, I want to borrow some money. And so people write these computer programs that say what it means to borrow money. And that might mean creating a new token. It is sort of like an automated government fiscal or monetary policy. Like a lot of this whole ecosystem really resembles like what happens if we reinvented the financial systems, but didn't force people to trust a central authority. And it's really quite interesting. So moving on, we're actually getting quite, this is taking us, I guess, the full time. So moving on, I'll talk about Uniswap. So if you're familiar with Coinbase, Coinbase will let you buy and sell all of these cryptocurrencies. And under the hood, the way it works is there's an order book. So there's an order book that says, I'm willing to sell this currency for this price. And that person is the maker, right, in traditional finance terms. And then you come along and you say, I'm willing to buy this for, well, what was my first example? The maker, let's say the maker is selling Ether. They're willing to sell Ether for $2,000. And you come along and you just want to buy Ether for whatever the current price is. So you fulfill that order. You're the taker on the order book. Make sense? You're familiar with the idea of an exchange. If you imagine the stock market from the 80s with like people holding tickets and shouting, looking for makers and takers and like actually trying to find someone else to make this deal. Uniswap is brilliant in its simplicity. Uniswap asks the question, what if we got away from the order book? What if we got rid of the order book? How could we do that? And the solution they came up with, and is now called an automated market maker. Uniswap allows anyone with a pair of two assets, Ether, DAI perhaps, to provide liquidity. So rather than say, I'm going to sell a particular amount of Ether at a particular price, you can say, I will provide liquidity. I will allow others to trade between Ether and DAI. And then someone else will come along later, and it's not that they're making a deal with me. I'm just providing some liquidity. And this liquidity is available to anyone that wants to trade between those assets. And why would I do this? Why would I provide the liquidity? Well, in order to do this trade, there's a 0.3% fee. And this 0.3% fee goes to the liquidity providers. Does this make sense? Liquidity might be a jargon term. I'm not sure if everyone here is familiar with the idea. But the way it works, if you want to provide this liquidity, well, I'll just walk you through it. So I have some Ether. What should I get? Maybe I'll get some ZRX. I will say I want to trade 10 Ether. Yeah, there's not. So in this case, there's not enough liquidity. But let's find another asset where there maybe is enough liquidity. Nope. Try one. This is probably because I'm on the test net. That liquidity is scarce. Oh, here, now we're good. So I could sell one Ether for 130 DAI. And this is having MetaMask pop up and say, are you sure you want to do this? You want to swap ETH for some tokens? I say yes. And this runs. And I can click on this. Etherscan is a service that basically watches everything that's happening. And so it could be pretty handy. So this was included in a block. This is going to be a lot of jargon, so it won't. I mean, it might be hard to understand what you're looking at here, but the idea is I just transferred one Ether and I just got 130 DAI. And I didn't interact with anyone in particular. I used the liquidity that was available. Is that people following along? People want DAI because it's $1. Do you trust that Ether is going to, what's Ether today? $2,000? Ether could be $1,500 tomorrow. Ether could be $2,500 tomorrow. I have no idea. But I have a pretty good idea that DAI is going to be worth about $1 tomorrow. So sure, if you want to expose yourself to the risk of the price of Ether, you can do that. Etherscan can do testnet transactions, right? So that's like normally you just go to etherscan.io, but because my demo, I'm moving lots of big money around. I'm doing it on a testnet. Etherscan does support that. But back to the question, like, why would you want DAI? Well, maybe you are not comfortable with the risk that's associated with the price of Ether, right? Like, I just want to move my money and I want to earn 12% interest like an honest person. I'm going to do it with DAI. I'm not going to spend $50,000 on Ether that could turn into $10,000 tomorrow, right? Does that make sense, Con? So anyway, I just purchased that DAI, and I'll show you the other side of it, the liquidity side. and I have Ether and I have DAI. Now I can help the system. The crypto market is not, I would argue that DAI is safer than Ether because of the track record. Yeah, I mean, why it's mostly, I would argue that mostly all of these assets are backed by speculation, at least these volatile assets like Bitcoin. Why is Bitcoin worth almost $60,000 is because people think it's worth $60,000. And so there's this feedback loop of like, well, if you think it's worth $60,000 and everyone else thinks it's worth $60,000, then if I want to buy some, I'm going to have to pay $60,000. As far as like, why is DAI more safe? Well, if you look at this chart, and I'll just pull it up in a tab. I just look at the price of DAI since all time, starting in like 2019, it's been fairly stable. And I mean, it hasn't been perfectly stable, but I mean, look at this chart. It only goes up to $1.05 and it only goes down to like 95 cents. And if you compare that with the price of Bitcoin over the past like 3 years, it's like that, or the price of Ether is like that. And if you zoom in, it's a lot of up and down. I'm not sure of the value proposition for XRP. I would argue, don't look at the price of an individual token. You have to look at the market cap. Because like if you look at Ether is this price, but it's this market cap. If this market cap and it's based on the supply. So if the supply were to double, you would expect the price of the token to drop. If you look at XRP, the supply is 45 billion. So will XRP be worth what Ether is today? I don't know. Maybe the market cap will be worth that. Hard to say. Anyway, I was showing you Uniswap. So I can earn money. I was talking about the fees for being a liquidity provider on Uniswap. There's this, every trade that anyone does on Uniswap like costs this 0.3% fee. So I can get access to those fees by depositing an equal proportion of ETH and whatever other asset, or any two pairs of assets, right? Like if I wanted to supply liquidity between these two pairs, I can do that. The market cap is determined by the price, right? If more people buy Ether, the price of Ether will go up and the market cap will go up. The market cap is just a function, total supply times price. So if more people are buying Bitcoin, there's not really more Bitcoin being created. Like if people are familiar, there's like a cap of 21 million Bitcoin that will ever exist. But more and more people are buying Bitcoin. So if you multiply 21 million by whatever the price of Bitcoin is, that's how you get the market cap. Does that answer your question, Beth? Cool. Yeah, so anyway, being a liquidity provider, I can do this. When I do this, I deposit, in this example, I'm depositing 10 Ether and 1,300 DAI. This is a test net, so I mean, if ETH were only $130, I would buy so much more Ether right now. But on a test net, that's what the price is. And what I'm doing is I'm giving these assets to Uniswap. I'm saying, hey, you hold on to these assets, and in exchange, give me these, what they're called LP tokens, liquidity provider tokens, or pool tokens, liquidity pool tokens. I give up these assets, I get back 108 ETH DAI pool tokens. I'll show you this in MetaMask. Just click through, hit confirm. It's going. I'll show you on Etherscan. Yeah, there's no inherent value, although with Ether, right, as I've described, in order, everything you saw me do, every operation, it cost Ether. So you can say that maybe there is some inherent value, because if people want to use this network, if people want to take advantage of these services, they're going to need to purchase Ether. So there's some inherent value, but it's not like, well, it really varies from token to token, right? Ether has value. If Ether were to have inherent value, it would be because it is used for these transaction fees. Yeah, anyone can have a test account. When you install MetaMask, you just do this drop down. Pretty much all these services that I'm talking about are on Kovan. You'll need to get Kovan Ether. So I fortunately had like 500 Kovan Ether. And that's powering this presentation, right? I'm just interacting with all these services the same as I would if it were real money, but it's a test net. So anyway, now I'm providing this liquidity. And here you can see I have, these are my pool tokens, and this amount will fluctuate. And if I go back to my slides, I just did this. I locked up 2 assets in equal value. I got my LP tokens back. I didn't do this part back to convert, but effectively I have this total percentage of the pool. I have on this testnet, I am contributing, like my assets are 1.74% of the entire liquidity pool for DAI Ether. If I want to get assets back out, what I will do is I will get back 1.74%. But what will you get back? I put in 10 Ether and 1,300 DAI. I won't necessarily get back 10 Ether and 1,300 DAI because of what's called impermanent loss. So in this example, I provided DAI ETH liquidity for that pair. If ETH goes up in value, that means that people are buying Ether. And if they do it through Uniswap, they're going to deposit DAI and get Ether, which means that the pool, the liquidity pool that represents DAI Ether, will have more DAI and it will have less Ether. Or similarly, the other way around, if Ether goes down in price, then the pool will end up with more Ether, right? Because, well, as I write here, if ETH goes up in value, that means more people are buying Ether, which means they're selling DAI for Ether, which means that the pool gets the DAI and gives up the Ether. And this incurs a loss, right? Because nothing is perfectly efficient. And so your total value, I don't know how much time has passed, but if I go and withdraw this liquidity, oh, I had an example from before. If I withdraw this, I might get back a different amount. I will get back the same 1.74%, but if the pool has more DAI than it used to, then I will get back more DAI than I put in, and I will get back less Ether than I put in. And I write this here. And the idea is, in effect, you get more of whatever asset performs worse. So why would you do this? Well, you hope that the volume of trade, that 0.3%, you hope that 0.3% that you get exceeds this fluctuation in price. You can convert many of these currencies back to dollars using an off-ramp like Coinbase. So Coinbase supports most of these assets. So you can transfer your DAI to Coinbase and sell your DAI for US dollars, and Coinbase will handle that. Or if there's some asset that Coinbase doesn't support, but Uniswap supports it, well, you could go and swap. Like, let's say Coinbase doesn't support, any of these. I could convert it to DAI, get DAI, send the DAI to Coinbase, and do the off-ramp that way. So like DeFi is kind of like this own little world where things are very interoperable and interchangeable. But if you want, cold hard cash, you're going to need an off-ramp. Now, the thing about impermanent loss, let's say, if I put in, the rate conversion is subject to volatility, right? If the price of ETH skyrockets and I'm providing liquidity, I'm saying I'll put in 1,000 DAI and 10 Ether, but suddenly the price of Ether doubles, I'm going to end up with a bunch of DAI and not as much Ether, and it will happen at a loss. And if this keeps going, if Ether keeps going up in price, I'm just going to lose all my money, because there's this, like, I won't get into the math, but it's very easy. This impermanent loss is very risky. But if the price ever drops back to the price that I put it in, then it goes away. Because, you know, if ETH goes up in value, the conversion back to dollars, yeah, it's subject to volatility. So like stable coins are pretty good because you can vaguely trust them not to be volatile. So anyway, impermanent loss is a little bit to wrap your head around. I think maybe I should USDC and USDT. It probably depends who you ask on whether or not they are DeFi. They are used in DeFi, right? Like I can have this. Yeah, I can trade for USDT using DeFi systems, but the value of this is backed by a central authority. Same with USDC. That USDC is Coinbase's stablecoin, and you can trust that USDC will be worth $1 because Coinbase themselves are willing to give you $1 for each USDC. If Coinbase were to disappear, go out of business, not that that will happen considering your IPO, then USDC would be worthless because the central authority that was saying, here, this is worth $1, they won't be around anymore. So Bitcoin was created, many people argue, as the result of the 2007-2008 financial crisis. The author of the Bitcoin system, he was, what's the word? Anonymously, Satoshi Nakamoto, he wrote the Bitcoin specification as a result of the financial crisis. So Bitcoin didn't exist until 2008, 2009. And that really was a direct result of like not being happy with the way that the financial system was working. But all of this stuff since then has really stemmed from that. Where was I? Yeah, absolutely. So I won't go into much more detail about impermanent loss. Fact is, it's very risky. I've lost a lot of money to impermanent loss, but I've also gained money from this system as well. I would describe Uniswap liquidity pools as like something of a high risk investment. But that's where the SushiSwap comes in. And SushiSwap, this is one of my favorite stories. They call it a vampire automated market maker. Because what they did, I mean, if we look at DeFi Pulse and we look at Uniswap has $5.68 billions of dollars worth of assets. SushiSwap came around in probably July or August of last year, and they said, we're going to copy Uniswap line for line. We're just going to copy Uniswap, but we're going to pay people to use it. And they did. They created their own token. They call that token Sushi. You'll see on the next page. And they said, if you provide liquidity for SushiSwap, we're going to pay you to do it. Uniswap wasn't paying anyone. Like, you get the trading fees, but you also have to suffer this impermanent loss. SushiSwap comes along and is like, yeah, we're just going to copy Uniswap, but we're going to give you money for using it. We're literally going to pay you to use our service. And it's remarkable. They stole, like they call it a vampire market maker, because they sucked liquidity out of Uniswap brilliantly. And now if you look at DeFi Pulse, SushiSwap is not that far behind Uniswap with $4.43 billion of assets. If SushiSwap wasn't around, well, you might think that Uniswap would have $9 billion or $10 billion worth of assets. But when SushiSwap came around, they said, we'll pay you to use our service. People were like, all right, I'll move my money over there. So that was pretty clever. But the idea, besides just like, well, see, look what can happen. The other thing I wanted to tell you about with SushiSwap is this idea of a yield farm. And this is another financial instrument that you see in DeFi, this concept of a yield farm. And basically, you can provide liquidity, same as Uniswap, and then you'll get rewards in sushi. And sushi, I don't know, today is worth like $14 per sushi. But basically, they're creating sushi. They're creating these tokens every day, every minute, and giving these sushi tokens to the people providing liquidity. Same risk with sushi as usual. Yep, there's risk all over the place. I mean, with these yield farms, there's the risk of impermanent loss, because if each of these is two assets, right? Like YAM Ether, Aave Ether, like all of these things are two assets. And if the price of those two assets fluctuate relative to one another, that gives you impermanent loss. But then if you're doing it for the sushi rewards, then you also have the risk that sushi will be worthless, right? And if I'm accruing however much sushi per day that I am, and I go, and if everyone takes all of these rewards and they immediately sell all of their sushi tokens, well, the price of the sushi tokens will plummet. And then there wouldn't really be any reason to use SushiSwap, would there? Because SushiSwap's whole value proposition is they'll pay you to use their service. But the price of sushi has been roughly stable above $10 for several months. It seems like it has been maintaining its value, but it's volatile like anything else. But these are still high risk investments, which is why you see things like 55%. Around, I don't know, Christmas time last year, I signed on and I'm like, wow, there's a Christmas present. I saw 400% ROI on some assets, right? And that's huge, but it's very high risk. So it's like, well, do I want 400% interest, or do I want to be safe? And that's a decision that we all have to make with our money. But it's pretty compelling, right? Like if you're coming from a traditional finance background and like the stock market gives you 8% per year, and you see these numbers that are like, and if I do the drop down, you can see, and this is a test net, but the top interest rate on this test net is 58%. That's huge. I switched to mainnet. I don't know what mainnet's doing these days, but it's not that uncommon to see like triple digits on SushiSwap. Like, yeah, here we go. Right now on SushiSwap, if you have Ether and Mark, whatever that token is, you could deposit those and earn an amortized 216%. It's like, it's right here, right? I mean, then these things fluctuate, of course, but there it is. So it's pretty compelling, I would argue. I mean, it's risky and terrifying, but it's pretty compelling. Like, who doesn't want to triple their money in a year? So anyway, this is a lot to keep track of, right? Like, who knows? Like, if I do this, if I put in, let's say I put in $10,000 worth of assets into this pool, into this yield farm, I could wake up tomorrow and this could be 0.5%. And then it's like, why did I waste my time? So what I could do is I could keep checking and be like, all right, where are the best rates? And constantly move my money around to figure out where are the best rates. And every time I move my money, I have to pay a transaction fee. And as I've discussed already, the transaction fees are quite expensive. So that brings me to my last case study, which is Yearn Finance, which is something like a perpetual money-making machine. And what Yearn does is Yearn is a bunch of smart contracts that look at all the other smart contracts that there are, and it says, what is the best interest rate right now? And then it says to users, we will pool all of your assets and we will move your assets around for you. And I described at the beginning of this talk that the transaction fee doesn't change whether it's $100 or $1,000. So Yearn says, let's pool all of these assets. And Yearn looks for the best interest rate. Yearn moves the money from one pool to another constantly to get this best interest rate. And they only have to pay the transaction fee each time they move it for everybody. And Yearn has like, what does DeFi Pulse say? It does not say. Yeah, this doesn't say. Last I heard, Yearn had like $3 billion worth of assets, I believe. Yearn does sound like a mutual fund, or Yearn is a bit like Vanguard, right? Like Vanguard is a managed money account. You trust Vanguard to keep an eye on the market and move your money into the place where it makes the most money for you. Except that Yearn does it without a central authority, without you having to go and sign up a Vanguard account, right? Like if I wanted to use Yearn, Yearn unfortunately is not on a test net, so I can't show it to you in action. I mean, I'm connected to mainnet right here, but it's pretty similar. You can just hit deposit. And then, I mean, this is like, if people are getting into DeFi, this is generally what I suggest as like a starting point. It doesn't necessarily require a lot of research, but 12% on something that is worth $1 and stays worth $1 is pretty good, right? Like, sounds like a better bank account. And you can see, I mean, this is a lot of words, but this is everything that it's doing is like, it lends DAI, collects rewards. It enters a yield, puts your DAI into a yield farm, earns rewards. And there are all these different strategies that it employs to find the best rate. And then it converts all of the earnings back into DAI. And so you deposit DAI, you collect interest in DAI, and at any point you can withdraw your assets. There is a slight fee for withdrawing on Yearn. Yearn takes 0.5% when you withdraw. So you want to leave it in there long enough to make up for that 0.5%. But like, I chose to demonstrate Yearn in this talk because I think it really brings together all of DeFi, right? Like you click on these strategies and it's like all of these different services that I didn't get into, like Alpha Homora I didn't get into, but I got into Compound. I explained Compound. And you can really see how these systems are interoperable, right? Like imagine if Vanguard discovers that a mutual fund or a particular stock is performing very well and they want to move their money around. Well, they have to go make a phone call and say, hey, I'm going to be transferring all these assets into this fund. And it's a lot of paperwork, I'm sure. I mean, I'm not in the finance industry, but instead in decentralized finance, in DeFi, you do need MetaMask. Well, you need software like MetaMask for Yearn. Yearn will work. All of these systems, right? Something needs to say who you are, right? I don't, like if I can't just like go on a website without any special software and say, yes, this is me. Hi, I'm OXEFEF ... I need some software that can prove it. And I won't get into the cryptography of it, but it's backed by like very complicated math that MetaMask protects your secrets so that you can act autonomously interacting with these systems. You don't necessarily need MetaMask, and maybe this is a good opportunity. Like all of these services, they typically have different integrations, right? So MetaMask is one of the most common ones, but you can use these other things. Like apparently Coinbase Wallet does it. If you have Coinbase Wallet on your phone, I think this involves like scanning a QR code. I don't use this. You can do your own research to figure out like what software you're comfortable with. But you need something like some software has to run. I like MetaMask just because maybe because I'm comfortable with it, I'm familiar with it. My employer maintains it is probably helpful, but it's very widely used. Like if you look at any of these services, MetaMask is always the first on the list because MetaMask is the most widely used. So where was I? Oh yeah, Yearn I think is like a prime example of what DeFi achieves because it takes all of these other systems that people have built that have been tested and it plugs them into each other. And it takes advantage of the fact that these systems can easily plug into each other. And I think that's really, really interesting, right? It's like suddenly we have this robot that's replacing Vanguard, right? I mean, it's not obviously nothing's going to replace Vanguard, but it's doing what Vanguard has been doing for decades, right? And so that's very interesting and I think very promising for this like new financial system. Should I cover all this? Yeah. The thing with Yearn is the vaults provide interest in the same currency. So like I showed you SushiSwap. SushiSwap gives you interest in sushi. Yearn gives you interest in the same currency that you put in, which is nice, right? It resembles a traditional bank account that you're used to. And the interest rates are great compared to I view Yearn as like a relatively lower risk financial instrument or financial system. Like Sushi Swap is like, yeah, I'll take my chance at 200% interest, but for long-term savings, I have a bunch of assets in Yearn because I can be patient. I'll earn 12% interest a year. That it beats the banks. So that's my last case study here. We have about 9 minutes left. I'll just summarize that DeFi it's creating this new financial system, and it takes out middle people, right? Like it takes out these central authorities that do a bunch of paperwork and have to charge extra because there's all this regulation. Now, regulation's good and all, but regulation costs money at the end of the day. And so without that, and since this field is so new, the return on investment is unbelievable. Like, I mean, on these first slides where you saw that, like, even the 12% interest is like, I don't believe that. But here I am telling you, 12% is pretty low interest in DeFi. But, there's risk. I already explained bugs. Like, this is all powered by software. Vanguard with their paperwork and their decades of experience, there's a lot of trust there, right? Like I would trust Vanguard to manage my money. Do I trust Yearn? Maybe. I trust some of these vaults, but Yearn is constantly making new vaults. Like look at on Yearn, there's all of these vaults and new ones are created all the time and people are experimenting, right? If you look at any of these, this DAI vault has 5 different strategies for earning interest. If there's a bug in one of these, well, depends on the severity of the bug, but you could lose money. So I don't know. I trust the DAI vault, but I don't necessarily trust some of these other ones. A lot of the time it's like wait and see. And sure, like initially when one of these vaults gets created, like a brand new vault will give you like 400% APY for one day, and then it'll drop as people become more comfortable with it and take advantage of it. So yeah, there's risks, and the fact that it's this interoperable system is like there could be like consequences that you wouldn't think about of these systems that are plugged into one another. You might not always think about, like the designers of these systems, they might not think about the consequences when these things are connected, and that's a risk as well. But as always, don't invest more than you can afford to lose. Do your research, and I at the very least hope you learned something from this talk. Thank you.
Thank you very much, Nick. That was great. If anyone has any last questions, if not, I'm going to drop the feedback form in the messaging chat. If you wouldn't mind taking that. If you don't have time now, I'll send out an email to everyone who is on the call.
And I'll put the link to the slides in the Zoom chat again. My email and Twitter handle are on the slides. Feel free to reach out. Happy to answer any questions. I'm very passionate about this stuff, and I'd love to talk about it. So, happy to follow up if anyone's curious about anything I talked about, or if they learned something that they don't understand, I'll do what I can to lend my expertise.
Thanks, Nick.
Yeah, thank you for having me.
Thanks for doing this for us.
No, it's a pleasure.
You might get a couple of questions from me as well.
Oh yeah, well, of course, Peter.
Thank you very much, Nick, and everyone have a great evening.
Yeah, take care, everyone.
Peter, thank you for doing this.
Thank you, Joan. Have a good night.
Thank you, everyone.